Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space.
One of the darkest times for us and has a very deep implication, and we are in a hole, but we're in the hole with an amazing team of people.
Dream11 founder and CEO Harsh Jain says the company will not legally challenge the new law banning real money games, also promises not to lay off employees, hopes to pivot to a free-to-play model driven by advertisements and sponsorships, also plans to launch global products. That's an exclusive.
Harajuku Tokyo Cafe, an authentic Japanese casual dining and QSR chain, has raised 19 crore rupees in its first institutional funding round from Samved VC, Let's Venture and Capital Ventures to support its aggressive expansion plans. The company is targeting 90 outlets across 20 cities and over 200 crore rupees in revenue by 2027.
Hexafun, a sustainability-driven lifestyle accessories brand, has secured 4.5 crore rupees in seed funding from early-stage investor Prajay Advisors. The proceeds will be used to expand its retail presence, strengthen marketing efforts and launch new product lines.
Paytm's parent company 197 Communications will invest up to 455 crore rupees in two of its wholly owned subsidiaries, Paytm Money and Paytm Services. 197 Communications will subscribe to a rights issue of equity shares for 300 crore rupees in Paytm Money and 155 crore rupees in Paytm Services. The company expects to complete the cash transactions within 30 days.
Elon Musk files a lawsuit against Apple and ChatGPT maker OpenAI, accusing both companies of joining hands illegally to stifle competition. Musk takes aim at Apple's decision to integrate ChatGPT into its smartphones through an exclusive arrangement. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Fintech startup Kiwi, that claims it pioneered the concept of credit on UPI in India, has raised $24 million in its Series B funding round, led by Vertex Ventures, Southeast Asia and India. In 2 years of operations, Kiwi has issued over 2 lakh RuPay credit cards, processes more than 5 million transactions every month, and the company says this fresh capital will power product innovation, sharpen unit economics, and help it scale to 1 million cards by 2027. Joining us now to talk about Kiwi's growth story and the future of credit on UPI is Anup Agarwal, co-founder and CEO of Kiwi. Anup, welcome to Startup Street. Now, with the fresh funds raised, you're planning to roll out EMI on UPI and add-ons for credit cards. If you could elaborate on what's next on the product roadmap and how do you see Kiwi's rewards program evolving?
Thank you. Thank you for having me on CNBC. Two questions. I think the product roadmap for us stems from customer demand. I think as we see today, most of the consumers are using credit card and UPI as a two-payment instrument. And what we are trying to solve for a consumer is to completely shift their behavior on UPI credit card. So do away with completely a physical credit card, which is there on their wallet. So that is what the first product line which we launched, and we are seeing tremendous amount of demand in that particular segment. The second area which we think is going to be which will see exponential growth is credit line on UPI. Basically, consumers who don't have a credit card will migrate to a credit line on a UPI product, which is basically they will have a line from the bank, which they will use for emergency or basically discretionary purchases into EMI. We are very bullish on that particular product line, because the consumer demand is very, very high for that segment because they don't have a credit card and their demand is basically to use their credit line for discretionary purchases. So that's where we are very, very bullish on. Yeah, so that we are going to invest in that particular category of...
Okay. You know, Anup, you've set yourself a target of issuing 1 million RuPay cards by 2027. What gives you the confidence to hit that milestone and what's the playbook to get there?
I think the confidence is because the market is so large and it is so underpenetrated. And we believe that the gap is primarily the education. Consumers today just don't know that they can transfer their UPI savings account transactions to a credit card. Just the education itself can drive insane amount of growth for us. And that's what we believe will be our growth trajectory coming from.
All right. So let's talk about the fundraise. Apart from accelerating the product growth journey, Anup, you also plan to strengthen unit economics. Now, what does that mean for Kiwi in practice? If you could share the current business growth numbers and how close you are to turning profitable.
So we have set ourselves a target of 2 years to turn profitable.
Okay.
Strengthen unit economics. I think the day we started our company, we were very clear that we want to have a very clear unit economics. And that is one of the reasons we chose credit card, which is a very healthy unit economics. Basically, ensuring that we are getting the maximum wallet share of the consumer on Kiwi through the cards which we have issued on our platform. That is something which we are focusing on very, very closely. We become the choice for all the transactions which are converted into an EMI, basically making our product so convenient for the user that we become the go-to product for all their credit needs. So those are the two focus areas for us as we
Okay.
strengthen our economics.
You already have partnerships with Yes Bank and AU Bank, and I believe you plan to onboard 2 more large banking partners within this financial year. Anup, what can you tell us on this front, and how critical are these banking partnerships in scaling your credit on UPI proposition? And with more players now entering this category, what will differentiate Kiwi in a competitive landscape?
Very good question. So look, ultimately, RBI is very clear that the credit line on UPI or credit card on UPI can only be issued by banks. And hence, banking partners are very, very critical for our success and for our growth. So having multiple banking partners allow for both. So banking partnership is key for our success. So that is something we'll continue to focus on. As you rightly said, the TAM is very, very large. The market is very, very large for UPI today. On UPI, 22 lakh crores are spent every month. And we believe that UPI credit on UPI will see about 2 lakh of spends in the next 3 years, which is currently hovering at about 20,000 crores, so 10x growth. So there will be a lot of players who will be eyeing to get into this particular space. I think Kiwi is poised with this right brand positioning in consumers' mind for the right experience. And we are focusing primarily on this particular category itself. And this three will help us win in this particular segment.
All right. Picking up from what you just mentioned, India has 350 million UPI users, but only a fraction use credit cards. You spoke about the opportunity, but how big an opportunity does this gap represent for Kiwi? And also, do you see credit on UPI eventually overtaking traditional credit cards in India, given the sheer size of UPI's acceptance network?
Very good question again. So 350 million, which is 35 crore consumers are using UPI. Credit card consumers are about 4 crores. If you look at unsecured lending, is given to about 12 crore consumers. So if you look at a difference, about 8 crore consumers don't have credit card but has a good credit history. We believe that a large portion of these consumers will eventually move to credit line on UPI or a credit card product in the next foreseeable future of 3 to 4 years. And that's where the opportunity is. So whether credit line will become larger than credit card, it's we'll see it in the future. I don't have any comments on that, but we believe credit line on UPI will become very, very large in the near future.
But at the same time, Anup, there are growing concerns around credit discipline in a market where millions are new to credit. So how is Kiwi building safeguards into the product, and what are you seeing on NPS so far?
So on the credit side, we partner with banks and the credit is underwritten by the banks. And banks have shown traditionally has been very, very prudent around discipline, around leverage, not lending to leveraged clients. They are highly prudent about making sure they are not over leveraging the customer. So we don't control the credit policy, which is the bank's prerogative in our case. But we have seen very low NPAs in our case so far. And I think this is something which is closely monitored by bank. So I think we are in good space there.
All right. You've said you want Kiwi to be the go-to platform for credit on UPI. So paint us a picture. What does success look like for you over the next 3 to 5 years in terms of revenue growth? And also give us a sneak peek of the product pipeline in the near-term future.
Awesome. So for us, there are many ways to looking at success. From a business perspective, I think if we have a 10% market share in the next 3 to 4 years as UPI credit on UPI grows, a 10 to 15% market share will be a win for us. And on the product line, we are launching, obviously, we already have a credit card on UPI, credit line on UPI will come, and we will deepen our credit card product roadmap and rewards roadmap for our existing customers so that it feels much more rewarding to be at Kiwi with UPI credit.
All right. On that note, it's time for me to wrap up this conversation. Many thanks, Anu, for joining us on Startup Street today, and wish you the very best for all your growth plans.
Thank you. Thank you. Thanks for having me here.
And moving on, India's baby products brand R for Rabbit has raised $27 million in a Series B funding round led by Filter Capital and co-led by 314 Capital. The round also marked a successful exit for early investor Exponential Capital. Founded in 2014, the company has grown into one of India's most trusted parenting brands with a revenue CAGR of over 35% since FY21 and an ARR now crossing $30 million. With this fresh capital, R for Rabbit plans to scale its omni-channel presence, drive product innovation and strengthen its digital reach as India's premium baby care market continues to expand rapidly. Joining me now to discuss this further is Kunal Popat, the founder and CEO of R for Rabbit. Kunal, thank you so much for taking time out and being here with us on Startup Street. You know, let's start with the fundraise itself, right? What will be the key focus areas for the $27 million that you've raised? Product innovation, digital expansion, or scaling distribution?
Okay. So thank you, first of all, very much to have me on the show. Okay. Regarding the fundraise, there are four major priorities. First, that we are going to invest is product innovation. R for Rabbit as a brand is known for its innovation in the product. And it's a brand which is built by the parents for the parents. So the brand was started by me and my wife being a co-founder with me, and started out of the dear needs when I became the father. And I was into corporate. So it was started with the dire need to have a great quality, most safety certified products for our country. That's how the brand was started. So safety and product innovation are the key pillars of the company. So the main objective to put the funds are product innovation, scaling up different channels like D2C is one of the key priority for us. Other channel developments, there are new channels that are emerging, so we want to focus on that, and putting more on the brand, because still we feel that brand needs to get in the mind of consumers. So we are still small in terms of brand penetration, and I think there's a lot to work on that.
So brand penetration is where you're looking to mostly work on. But India's, baby care market is rapidly premiumizing, right? So how is R for Rabbit sort of positioning itself to capture this growing demand? If you could kind of take us through the growth you're witnessing, and how are you keeping yourself ahead of competition?
Okay, so as you rightly pointed out, okay, that India is moving towards premiumization. R for Rabbit foundation is on the premiumization. We are not a massive brand, or we are not into, we are a mid-premium or premium brand in the baby category. What separates us apart is the products, okay? The amount of efforts that we invest and the amount of nitty-gritties that we have in our products separate us, and consumer love us for that. In terms of NPS, if I can say that we have one of the best NPS in the industry, which is 80%, okay? So consumer love us because what we are giving to them. How we are, at the end of the day, like your product speaks for itself. Okay, your brand speaks for itself. So brand and product will take care with the competition.
All right, so brand and product will take care. So you're saying what sets you apart is the type of products that you have. You delivered over 35% CAGR since FY21 with an ARR now exceeding $30 million. So what are your growth targets for the next 3 to 5 years? And also, if you could tell us where you hope to end this year.
Okay. We are expecting to end this year close to 40 million, 45 in terms of ARR. It will be around 50 million. Okay. In terms of net revenue, around 45 million. As I said, that where we are going to get the further growth. So as new channels are emerging, like quick commerce. Okay. So we are going to invest our time, money, efforts to develop this channel. Second, we are still yet to get strong on the foothold of India, which is tier 2 cities and the offline presence. Our offline presence still needs to be better compared to what it is now. So we are going to expand the team to strengthen our offline presence. Third, we are going to expand in the categories. lot of categories, or I would say subcategories in the 5 major categories that we deal with, where we call it low-hanging fruits or a subcat, even the categories. That's the major expansion plan looking like. More on the channels, strengthening our core channels where we are into, developing the new channels as I spoke, and expanding into different subcategories of baby.
All right. And, R4 Rabbit, like you pointed out, also boasts an NPS of 80 plus and a strong organic traffic, right? So what has been the secret to sort of building such deep trust among Indian parents? If you could take us through which of your categories is doing the best right now, and, what are these subcategories or new categories that you're looking to enter?
Okay. So you need to understand the gene of us. Okay. It's a company started by parents for parents. So when the founder gene, and founder himself is a parent and so passionate about the quality and the innovation on the product, it will come out in the products. Okay, that's the gene. And we being a company started with the core philosophy of parenting, making this journey of parenting easier, or I would say parenting solution. That's where our key focus is. Okay, in terms of so that's where I would say that we are very strong into. Second question that you asked is about subcategories. Okay, in terms of subcategories, let's say there are 5 major categories: baby gear for us, diapering, ride-ons and toys, baby furniture, and feeding and nursing. We see that feeding and nursing and furniture are having a strong momentum of growth for us, and the leading category for us at the moment is baby gear and diapering. We are consumers are accepting us, and we are one of the leaders in the premium segment in these categories.
All right. So diaper is where you're seeing like most of the traction. You've highlighted your omni-channel distribution as a key growth driver, right? How do you sort of plan to balance the online and offline presence to reach modern Indian parents more effectively? And how many, stores are you currently present in? What's the revenue mix between online and offline?
Okay, very nice question, I would say. In terms of number of stores that we are present, we are currently into 2,000 plus stores across the country. Still, there are, if you ask me how many stores you can be present, I would say that we can still be present in 3,000 plus stores, where we will, put our efforts and expand our team to be present. In our category, baby as a category, it's a highly researched category. Okay, mothers put their heart when deciding a product for the little one. Every mother wants to, first of all, touch, feel the product. That's how we are going to balance our omni-channel, that the more the presence of the product that we are able to create in offline space will give a room for experience the product to the mothers. In terms of distribution of the business of online and offline, currently, we are 65% more digital or online, 35% I would say offline.
All right, so 35% offline. But, you said you're present in over 2,000 stores. If you could sort of tell me, where are these stores, currently present across India? Take us through what the presence is. How many cities are you sort of catering to? You're obviously targeting the premium segment. So what's the expansion plan?
So in terms of number of cities, we are present in top 40 cities. The major stores that I'm talking about are present in top 40 cities. But what we are seeing is strange, like, not, I wouldn't say strange, but India being changing, okay? We are seeing a strong demand coming from tier 2 cities, even from the places like Northeast, like Arunachal Pradesh, Nagaland, sometimes gives you the revenue or the footfalls that they carry, or the spending capacity that they carry is far out of the blue that you can think of. Kashmir, you feel that Kashmir is not a lot of people feel that it's not a great market, but for the premium products, they love premium products and they love quality. Lot of pockets like this, Kerala is one of them. Such are the pockets that we need to strengthen ourselves, where consumers are looking for a premium quality products for the little one. So we are gonna go deep down into all those territories in the country.
All right, Kunal. So you are going to deepen your presence across all of these territories. All right, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on your journey going forward.
Thank you very much. Thanks a lot.
On that note, it is time for us to head into a short break. But coming up next, smart kitchen tech brand Beyond Appliances has raised $4 million in Series A funding. How do they plan to use the funds to scale the business? We put the firm's co-founder Ishwar K. Vikas on the hot seat to find out more. Stay tuned.
Welcome back. You're watching Startups. Welcome back. You're watching Startup Street. Now, smart kitchen technology company Beyond Appliances has secured $4 million in a Series A funding round, which was led by Fireside Ventures. This capital is going to be deployed to scale its manufacturing capabilities. It currently operates about 4 facilities and plans to set up 2 additional units in the next 12 months. It also claims to have doubled its revenues post the seed round in November last year and now aims to strengthen the core product categories while also expanding into new appliance segments, which will be supported by this upcoming manufacturing capacity. But for more on the company's growth trajectory ahead, joining me now is its co-founder and CEO, Ishwar K. Vikas. Ishwar, thank you so much for your time here on CNBC-TV18. Briefly tell us about Beyond Appliances and how do you plan to strategically allocate this $4 million?
So Beyond Appliances is a smart kitchen appliance company. We have seen that there are a lot of changes that has happened in various smart homes. Like you have smart TVs, you have vacuum cleaners, you have everything. But smart kitchen appliances is something that has not come. And we spend a lot of time in kitchen. We love to cook and we spend a lot of time. So we said at Beyond Appliances, we'll make smarter chimneys and smarter stoves / hobs. That's what we do. And because we are seeing a lot of demand and requirement for production, and hence we have raised some capital right now that is going to help us make our production better. We are going to invest in a couple of new facilities where we are going to manufacture all these products while we have been making them in India right now. Bulk of the will create a lot more facilities here and also to build brand and create a lot of IP around this whole kitchen space. So that's where we are going to use this capital for.
Okay, Ishwar, currently you operate 4 manufacturing facilities, as we understand, and this plan to set up 2 additional units in the next 12 months. Where will these be and what kind of production capacity increase is this going to give you?
So we are going to open 2 new facilities while we might shut down 1 or 2 of existing because the 2 new facilities will be quite massive. We'll be looking at 1 chimney and 1 hob facility, 1 for stoves and 1 for chimneys. We are yet to zero in on where the location will actually be, something we are still searching for. But once these facilities are ready, we'll be looking at huge volumes that we can do. And with BIS standards and everything that are coming in, I think we'll have some of the best labs and some of the best production equipment that can do the smart appliances at.
All right, got that. You've doubled your revenues since your seed round, you say. What is driving this kind of growth, and how confident are you about getting to that 400 crore ARR target in the next 3 years?
See, the industry, Ritu, is quite large. It is a $2 billion industry between chimneys, stoves, and hobs. It's a very large market, and today customer is looking for new appliances, smart appliances. They want the latest in the market. They want the best feature, because when you're redoing your home, or when you're upgrading your home, you want a better feature. Nobody buys a normal TV anymore. They buy a smart TV. Nobody buys a normal watch. They all buy a smart watch. Similarly, there is a trend to buy better kitchen appliances, because in Indian context, kitchen is like the heart of the home. So people always want a better and the newer appliance that can come. And hence we feel, because it's a $2.5 billion market, CAGR of around 15%. So we feel that the number which we're looking for is sort of doable. And hence we feel that these are good targets for us to have our results.
Okay, got that. Quickly, Ishwar, as you expand beyond Bengaluru and Hyderabad into markets like Mumbai and Delhi, what is the role that offline retail and modern trade will play compared to your D2C and online channels?
While we are heavy on e-com and D2C right now, we see a lot of inbound demand from a lot of modern trade and retail partners across the country, because most of the people in all the other cities also want to see and touch and buy the product. There's a lot of demand for them in these respective cities and their respective outlets, and hence we will definitely expand offline as well, but we plan to remain a digital first brand in the near short term.
Okay, and finally, Ishwar, before we let you go, the kitchen appliance market is very much dominated by legacy brands today. What is your moat in terms of technology, pricing, and consumer adoption, would you say?
See, I think the real moat is consumer insights. Legacy brands have done a fantastic job and continue to do a good job in terms of distribution, brand, and manufacturing. I think creating specific IP, like my stoves have timer, my chimneys have Android screens, we have integrated AI features in our chimneys which can count whistles and turn off the stove automatically. So these are some of the industry first IP that we have created, and hence we feel that the customers today love these features compared to what is already available in the market, and that is the moat for us to ensure that customers like to buy our products, we believe, than other products out there.
All right, Ishwar, we'll leave it at that. Thank you so much for your time here today on Startup Street. It's been a pleasure speaking with you. And on that note, we're going to say goodbye from all of us, and thank you so much for watching. But stay with us. More news and updates will continue after this break.